In this presentation, we will take a look at an example problem related to a not-for-profit organization, which has two programs. We're going to be entering the transactions related to the not-for-profit organization here. We'll continue on with this example problem after that, recording things like the closing entry, allocation of expenses by function, and then the financial statements in future presentation. The information is going to be up to the left here. We're going to record the journal entry related to it, and then we'll post the journal entry to our trial balance on the right side. Note that the trial balance will be in order. The trial balance worksheet is going to start with the assets in green, the liabilities in orange, what would be the equity in a for-profit organization, the net assets here in the not-for-profit organization in light blue. As we see these net assets, note the new thing that we need to break out here. That is the ones that have with restrictions, the ones that do not have restrictions. We see balances here already. We're going to continue on with that. When we close out the activity, we'll have to do that allocation as well in the closing of the temporary accounts to the net assets. Then we have what would be the income statement type of accounts in a for-profit type of organization, similar to a not-for-profit organization in a for-profit revenue and expenses. Not-for-profit, similar type of activity. We're going to have those temporary accounts, those that measure kind of performance over time. Note that these accounts are also going to be, they're going to be named a little bit differently, but they're basically the same kind of concept. We have the contributions, which are kind of like the revenue account. However, here, unlike a for-profit organization, we have to break out the contributions between without restrictions and with restrictions. Once again, that's going to be one of the new things, of course, that we will have to track in the not-for-profit organization as opposed to the for-profit organization. And then, of course, at the bottom, we're going to have the change in the temporary accounts, which is kind of like the net income or the change in the net assets. We're going to have two programs in our organization. Those two programs are going to be the exhibition and sales of crafts. So arts and crafts going to be crafts. And then we have the education about crafts. Those are the two things, the two objectives, the two programs that this not-for-profit organization is involved with. We're going to have our first transaction or data related to it in this white area here. We will then construct the transaction or discuss how it has been constructed down below. These are going to be related to revenue type of accounts typically, and so we're going to kind of group them together. You could also think of them as separate types of transactions. We're going to group them together, however, here. So we're kind of thinking about the transactions in more of the period as a whole type of thing, as opposed to going through every transaction within the time period, focusing in on those areas where the not-for-profit will be different than the for-profit. Okay, so we have the unrestricted cash received. So unrestricted cash received, we have grants. So we have the grants of the $12,900. So we've received cash with relation to grants, had been reported as receivable. So of the $12,900 that has been received, $5,100 has been reported as a receivable. So therefore, the difference between the $12,900 and the $5,100 was not reported as a receivable. We then are going to report that amount as income. Then we have the fund drive and unrestricted gifts. That is going to be another form of basically revenue, given the fact that we're a not-for-profit organization. That's how we basically earn revenue. That's a kind of revenue type of transaction, or the equivalent of that. It's going to be increasing a revenue type of account. Therefore, we know that cash is going to be the debit. So we're going to say cash is here, but in essence, we're going to think about that last. It'll be the sum of all of these transactions. Then we're going to say that we have the $12,900 minus the $5,100 that have been reported as receivable, which is not going to be income. Therefore, of that, the $12,900, $7,800 is income. Then we're going to add to that the $13,981 plus the $13,981. That's going to be $21,781. That's going to be the amount here that we're going to report in contributions without donor restrictions. Contributions without donor restrictions is going to be our revenue account. Here's our revenue account up top. That's our primary revenue account. That's the one we really want. We don't have any restrictions on it. That's why we like it. Then we're going to have the $5,100 is representing the amount of the receivables that are going down. So you'll note up here we have the grants receivable. I know it's a little small, sorry about that, but we have the $5,800 is the receivable. It then will be going down by the 5,100 that we have now received. Then we have the membership dues. So the membership dues, we're going to have that as a kind of revenue account as well, but it's going to be in a separate revenue account. So we got the membership dues here. That then will also be increasing in the credit direction, bringing the net income type of account up, or the change in net assets. Then we have tuition and fees. The tuition and fees also a type of revenue type of account. That's going to be right here, tuition and fees, type of revenue account. It will be increasing as well in the credit direction. Next, we've got sales. Now, I'm going to explain the sales a little bit here. We're going to say that we sell crafts, but the crafts are donated to us by donations. We're going to sell the crafts and then basically give the funds to the people who donated. So we can kind of think of the crafts that we sell as almost on consignment. They're owned by the craftsmen, the artists who give them to us. We then sell it. We give them the proceeds. However, we keep 20% of it. So we keep the 20%. So the revenue that's going to go to us is going to be the 20%. So we're going to say we made sales of 12,230. However, of that, the only part that's actually revenue to us is 20%, 0.20. That's going to be this 2,446. That's the amount that's revenue to us of the sales we made for crafts that we don't actually own, which are kind of like donated or on consignment for us. We then sell them in our not-for-profit organization and keep that 20%. All right. Then the difference between that and the sales amount, the 2,446 minus the sales amount, which is 12230, is the 9,784. That's going to be the amount that we owe to the craftsmen, the people that made the crafts that we're selling, craftsmen and women. So that's going to be a credit of the 9,784, which could also be found if we said that we had the 12,230 times not 20%, but if 20% we keep, we have to give away 80%. 100% minus 20%, 80%, 80%. So we got 9,784, same number. All right, so then if we post it, then obviously if we add all these up, it's going to add up to this 62,980, the total cash. So that's going to be our transaction. Now, again, you could think of these transactions as separate transactions if you so choose. Basically, we would have the credits being here and a debit to cash for each individual of these transactions if you so choose. We're grouping them together, them all being basically kind of revenue type of activity for the time period. Posting them out then is here. So we've got the cash. Cash is going to be up top. Cash is a debit balance account. It starts at a debit. It's increasing in the debit direction to the 65,575. Then we got the contributions without donor restrictions. It was at 0. That's kind of like our revenue account. It's going up in the credit direction. That's not going down in the hole. That's going up in the credit direction to that 21,781. Then we've got the grants receivable. That's going to be an asset type of account up top, asset type of account, the grants receivable, then decreasing because they paid off the grant and therefore it's going down to the 700. Then we've got the membership dues. The membership dues is going to be a type of revenue account. So it's going to be here, membership dues. It's going to be going up in the credit direction. So again, this is an increase. That's not a negative number. It's a credit. You could think of it as a negative number, but it's a credit here. And then we've got the tuition and fees type of revenue, it too going up in the credit direction. Then we have the commission revenue also going up in the credit direction. And then finally we have the payable to the craftsman. This is what is owed to the people that made the actual crafts. We got the payable to the craftsman, it going up in the credit direction. We can see what happens to the change in the temporary accounts, kind of like the net income accounts, which would be the change in activity for the statement of activities. Those are going to be the dark blue accounts where we just have these items, all revenue so far. This doesn't represent a loss. It represents revenue going up. This is the net kind of income at this point in time. Next transaction. We got interest on investments without donor restrictions of the 688. Interest on investments restricted for programs, the 947, and the interest on investments in the permanent endowment. All right, so we're going to have, what we're talking about here is we've got investments interest has been earned on the investments, and therefore the typical kind of journal entry we would think then would be cash would be going up, some type of income, interest income, it would be the credit. However, of course, here we have restrictions related to it, so we're going to modify what would be done for a for-profit organization a bit. So the modification will be related to the restrictions. Investment on, so the interest on investments without restrictions, we're going to credit the investment income account that has no restrictions to it. So we've got investment income. It's going to be a type of income account. And you'll note we have with and without restrictions. And this one is going to be without restrictions. That's the one we like, that we don't want restrictions. No restrictions. That's what we would like to have. Okay, so that one's going to be increasing there. And then the interest on investment restricted for programs is going to be obviously the investment account with restrictions. And then we have interest on investments in the permanent endowment. So again, the endowment would be something typically where someone put an endowment in place, possibly a permanent investment. The permanent investment then earning investment income on it. That investment income then is necessary to be used in some specific format within the not-for-profit organization. We're going to say here, I believe, for the education, some type of specific education within the program. So that then, of course, will be also restricted. So we're going to say then that we have the unrestricted portion is going to be that 688. The restricted amounts will be the 947 and the 356. And that's going to give us the 1303. So the cash is going up for the total interest. However, we're going to credit and increase the amounts for investment income for the restricted portion of the 1,303 and the unrestricted or without restriction, the 688. Posting this out then, we've got the cash. Cash is up top. Cash is going up in the debit direction. Then we've got the investment income with restrictions. That's going to be this top one. And that's going up in the credit direction. This is also kind of income, increasing what would be thought of as kind of like net income for the not-for-profit organization. Then we have the investment income without restrictions, which is at 688. It's going to be increasing as well in the credit direction, increasing what we would think of as net income, that being, of course, all the dark blue accounts, only income thus far, therefore not a loss. That's income thus far. Next transaction. We have grants receivable increase, so an increase to the grants receivable of 5,260. Then the amount earned in the current year, therefore no donor restrictions. So we're going to say it's going to be that amount that's been earned in the current year and does not have a restriction is the 3,240. The deferred revenue at year end, the amount that's going to be deferred revenue at year end is 2,020. So we're going to say that we have a full receivable. The receivable will be for the 5,260. That's going to increase the accounts receivable, similar to like if we were going to give an invoice in a for-profit type of organization. We expect to have that at this point in time. Therefore, we're going to record the receivable of 5,260. We're going to credit the contributions with donor without donor restrictions, because we have no donor restrictions on the portion of the 3,240, because that's the amount that has been earned in the current year. So that's going to be like the revenue account. That's similar to what we would expect in a for-profit organization. If you were to say invoice someone, right, you would debit the receivable, credit sales, or some type of revenue account. That's in essence what we're doing here. However, the 2020 portion is deferred revenue at the year end. And therefore, what we're basically saying there is we have not yet earned the revenue, therefore can't record it as a type of revenue account or a contributions account in the current period, and have to record it as deferred revenue, which is similar to like unearned revenue that we're getting. We're going to record the receivable for, but it has not yet been earned. And in the following period, when it is earned, we would have to decrease the deferred revenue and record the expense in the proper period when the revenue recognition principle had been met. So let's see what this would look like. We're going to say the grants receivable. Grants receivable is going to be an asset account up top. The asset account is going up in the debit direction. Then we have the contributions without donor restrictions. Contributions without donor restriction, it is going up in the credit direction. So it's going to go up in the credit direction. Then we have the deferred revenues. Deferred revenues is going to be a type of liability account. That's going to be something that is going to be going up in the credit direction. So the deferred and that goes up, and that means We also had an increase down here in the change in the temporary accounts, the net income type of number, the change in net asset type of number. And that's, of course, all of these dark blue numbers. The change was an increase in the contributions, which means that there's an increase to the net income type number as well. Next transaction. We have building rent provided. The value per year is going to be the $19,100. So we're going to say that we've been provided a place for our not-for-profit organization free of rent as a type of donation to the organization. So in other words, we got some kind of value, the use of the facilities, without paying rent on it. So what's going to be the transaction related to this? You could think of this kind of like a bartering transaction, or we got something, we got a donation, and we didn't really barter, we didn't give anything back, but they're giving something to us, a donation that isn't cash related. Therefore, we're going to say that we got the donation, the contribution without donor restrictions. We're going to have to value it somehow, which can be a little bit difficult, but we should have a kind of market value estimate for the value of the rent that we are receiving. And that's going to be an increase to the restriction, to the contributions without donor restrictions. And then the other side is going to be recorded to rent expense. So we're going to expense the amount that we are consuming at that point in time as well. So we have an expense of the facility that we are consuming, even though we're not paying for it. We're recording the other side as basically revenue that's being provided to us. So revenue's going up, expenses going up. Also note that, of course, it's going to be without restrictions. And you might say, well, it's pretty restrictive. You have a facility. There's only so much you can do with it. You can do work in the facility typically. But also note that the without restriction means that they didn't specifically put a restriction on the thing that they donated, whether it be cash, which means it's going to be, we could use it for whatever we need within the confines of our not-for-profit organization, or they can give something else, but as long as they didn't say that, they're going to say, I have an added restriction to how you can use the contributions that I made, whatever format that will be, we will consider it without restrictions. So the format, in other words, the format of what we're receiving isn't what we're talking about with regards to the restriction. It's the content of someone saying, I would like this to be used in some specific way. All right. So then we're going to say, and post this out, we got the rent expense. Rent expense is going to be an expense account. It's going to go up in the debit direction. So we have the increase in the rent expense, and then we have the contributions without donor restrictions up top. That's going to be a revenue account. It's going up in the credit direction. So note we have an increase and a decrease. The net value is going to be neutral on the net position, although there is an effect, of course, on the income statement type of account or statement of activities types of accounts. One going up revenue, one going up expenses, meaning revenue minus expenses in essence stays the same. Next transaction. Here we're going to record most of the expenses for the time period. Now again, we could think of these as separate types of transactions we would record throughout the time period, but our focus here is on those types of things that are different from a not-for-profit organization to a for-profit organization. Therefore, we're going to kind of group together a lot of the expense type of activities and record them at one point in time. All right, so we've got the salaries expense, the $48,200, the utilities expense, $3,200, the printing and postage, $1,530, the miscellaneous $760. Those are going to be straight up expenses that we're just going to record for the entire time period in their related expense accounts as we would for a for-profit type of organization with the salaries expense, the utilities expense, the printing, and the miscellaneous expense. We're also going to record the prepaid expense balance, which is kind of, you can think of this kind of like the adjusting type of entry. We're going to think about what's in the prepaid expense balance and adjust it to this 960. So what's in the prepaid expense balance? We're going to look at the prepaid expense balance of the 1,240. So we're going to say 1,240 minus what we're going to say it should be at the end of the time period, 960. That gives us the difference or the change of the 280. Therefore, we need a credit of 280 in order to make this 1,240 go down to what we determined it to be at the end of the time period, kind of like an adjusting type of entry, or it is in essence an adjusting entry, that being the 9,060. Next, we have the accounts payable and accrued expenses at the 2009-26. Same process here. We're going to take what is in there, which is going to be the 2,769 minus this 2009-26. That's going to give us a difference of the 157. In other words, we need a credit of the 157 in order to make that 2,769 be what we think it should be at the end of the time period. That is the 2009-26. So there's going to be our transaction here. And then if we were to take the debits minus the credits, that's what we're going to say was paid for with cash throughout the time period. So of course that would be, let's do the math here, 48200 plus the 3200 plus the 135 or 1530 plus the 760 minus the 280 minus the 157. And that's going to be the 53,253. That's going to be the cash. So the debits then equaling the credits. We can then post this out. Again, you could think of these as separate type of transactions if you so choose. We're grouping them together because they are in essence similar to what you would see in a for-profit type of organization. And therefore, we're going to do them fairly quickly. All right, so then we've got the salaries expense. We're going to post the salaries expense. That will be here. It started at 0. We're going to be increasing it in the debit direction. So that's a debit now. And that'll be decreasing, of course, what would be the net income. And then we've got the utilities. Utilities is going to be here. It's going to be increasing as well in the debit direction. Then we have the printing and postage. The printing and postage is here. It's going to be increasing in the debit direction. Then we have the miscellaneous expense. The miscellaneous expense also increasing in the debit direction. The credit then going to the prepaid expense. Here's the prepaid expense. If we scroll up top to the prepaid expense, we see here it's an asset. It's a prepayment. It's an asset. It's going down because we're decreasing it to the 960, which we determined is what it should be at. That's kind of like our adjusting type entry. Then we have the accounts payable and accrued expenses. And that's going to be here, the accounts payable and accrued expenses. It started here. We are crediting it to get it to the 2009-26, which is what we determined at the end of the period it should be. And then, of course, the difference finally going to cash. Cash then decreasing for the time period down to the 14,313. Note the effect on what would be like the net income or the change in the net assets. It now at a loss. So we had a revenue before by the credit, meaning credits in the dark blue accounts, income minus expenses or revenue minus expenses. You can think of it as being revenue winning, credits winning. Then over here we have a loss. Now that we've recorded all the expenses that we have, now we have a loss of the 363. Next transaction. Short-term investment sold is going to be the 3,500. The proceeds of that sale are going to be used to purchase computers and printers. Resources used were restricted for the purpose of purchase of equipment of the 2,855. So let's break this out. This is going to actually be 3 different transactions. Short-term investments sold. That's going to be the first transaction. Will be a straightforward one where we're going to sell the short-term investments. So we have investments. We're going to sell it for cash. Typically, we want to sell them for cash so that we can use the cash to do something with. The next transaction then will be us doing something with that cash, purchasing computers and printers. So then we'll record the purchase of the computers and printers with cash, which will be an increase to equipment because it's going to be a property, plant, and equipment type of purchase, and the credit to cash. We'll talk about that next time. And then we're going to have a third transaction that's going to be the result of the fact that we had some money that was restricted for specifically the purchase of equipment. Now we're purchasing equipment. We want to make sure that we unrestrict the money that we used in accordance to that restriction so that we have unrestriction as much as possible. So that's our goal. First, we'll record the first transaction similar to a for-profit organization, straightforward type of transaction. We're going to say that these short-term investments are sold. They're going to go down. These are a debit balance. We need to make them go down by doing the opposite thing to it, a credit. The other side, of course, going to cash. That's what we're going to get for it. Cash then increasing. Cash is a debit balance account. It goes up with a debit. Transaction here then, cash. If we post this out, it's going to be increasing the cash account with that debit to the 17,813. And then we're going to credit the short-term investment. Here's the short-term investment. We will then credit it to bring it down to the 9,811. No effect on the income statement or statement of activity type of accounts in the dark blue. No effect to what would be net income or change in the net assets. Next component of this transaction is the purchase of equipment. Again, fairly straightforward, same as a for-profit organization. The equipment account would then be increasing. Here's the equipment account increasing. We're paying cash for it. Note, of course, we're purchasing equipment, and therefore we're not going to expense it at the current point in time. We're not putting it down here as an expense. In other words, we're putting it up top as an asset, something that we will consume over the next time period going forward. We will then allocate the cost of it in accordance with the matching or expense recognition principle. And then if we record this transaction, it's going to look like this. We're going to say that the equipment will be debited. Here's the equipment account. We're going to debit it. It's going to be increasing the equipment account. The cash then will be credited. Here's the cash account. We're going to credit the cash, and the cash account then going down. Once again, no effect on the basically net income or the income statement type of accounts or the statement of activity types of accounts. They will be affected at the point in time that we record the depreciation related to the cost allocation of the equipment. Next, we have the new thing. This is the different thing that's going to happen. The thing that's different from a for-profit organization to a not-for-profit organization, and that is the fact that we had some restriction. Someone gave us money. We had a donation of some kind that said that it was restricted to the spending on equipment. So now whenever we spend money on something that we have a restriction on, we assume that that's the money that we spent on what we purchased, so that because we always want to unrestrict the money if we can. So this is the critical transaction that often it's easy to kind of miss this transaction and say and not unrestrict when you can do so. So you got to make sure that we want to say anytime we can unrestrict something, we want to unrestrict the transaction so that we can use the funds appropriately, be free to use our funds in accordance with the objectives of the not-for-profit organization rather than having further restrictions to it. So what we're going to do here then, this transaction is going to be using these two kind of funny accounts. These are the new type of accounts here that you don't see in a for-profit type of organization. And they're basically going to be moving something from a restricted position to a not restricted. They're called, and you can read them better over here, net assets released, satisfaction of purpose restriction with donor restrictions, and the same thing, however, without donor restrictions. If you see them over here, they're on basically what would be similar to the income statement, the statement of activities. And you can see the keywords here is one without restriction, one with restriction. Now the one without restriction is the one that's going to be going up. That's what we want. We're always going to be increasing the one without restriction because the purpose of these two accounts is to take something that was previously restricted, transfer it to the unrestricted. You can think of it kind of like fund accounting, going kind of like from one fund to another. You can think of it similar to that process, or an intercompany type of transaction. So the one with restriction then is going down. Now I would think of these accounts as income statement type of accounts, or revenue, I should say, type of accounts, which have credit type balances. Therefore, to increase the one without restrictions, we would do the same thing to it, a credit. So we're increasing with a credit the one without a restriction. The one that's going down, I would think, would be the other one, because I would think of it as an income statement account which has a credit balance. It's going down. It was previously restricted. We're taking stuff that was previously restricted and unrestricting it. Therefore, we debit, decreasing the one with restrictions. This will be our transaction then. If we post it out, you'll see that the one without restrictions will be going up, I'm going to say, in the credit direction. This is not a decrease. This is an increase in the credit direction. This one's going to be going down in the debit direction. Now you might say, hey, there's nothing in there. They both look like they're going up. And you can kind of think of it that way because this one will always go up in the credit direction. This one will always go up in the debit direction. But what's really happening here is this amount is increasing the amounts that are without restriction. These are decreasing the amounts with restriction. The reason it looks a little bit funny here, it's a little bit difficult to think about when you have this kind of vertical setup in the trial balance, where we have to line up what is restricted and not restricted in the same column with just names to the accounts. This will make more sense. It'll look more logical when we get to the statement of activities, which is the statement similar to an income statement in a for-profit organization, which will have two columns breaking out the items that are without restriction and with restriction. These two items then will be allocated between those two, the one increasing the one without restrictions, the other decreasing the one with restriction. The net of the two, of course, netting out to 0, but showing that allocation to having no restrictions for something that previously had restrictions. So we'll see the statement of activities in a future presentation. Next transaction. Income earned by the endowment was used to provide craft education per term. So we had income that was earned by the endowment. The endowment's going to be a type of investment. It earned income. We then took that income and we used it for craft education because that's what the endowment forced us to, told us to use it. Those were the terms of the endowment. In other words, you can think of an endowment typically as something like an investment. Oftentimes, that's going to be a permanent type of investment. We then being able to take the income on the investment and use it in accordance with the terms of the endowment, although not touching the principal oftentimes, and therefore we have to make sure that we use the interest in accordance with the terms. And the terms here were to use it for craft education. So we spent this specifically on craft education, and then once again, whenever that is the case, we want to make sure that we unrestrict the assets, right? So we're going to have that same kind of transaction moving from the with restrictions to without restrictions. So the transaction then is going to be community education. It's going to be a debit. This is the first transaction because that's what we spent it on. That's the activity we spent it on. And then we're going to credit cash. So this is going to be a debit to cash. A credit to cash. Cash is going down because we're spending it. And then community education, the kind of expense account is going to be going up. That would be bringing down what would be similar to net income or the change in the net assets in the income statement or the statement of activities type of account. Then we're going to have the new transaction. Once again, it's going to be using these two transactions or these two accounts. And we're going to have the transfer because we then once again met a requirement and therefore we want to unrestrict any assets we can in order to use them in an unrestricted type fashion. So once again, we have these two accounts. One's with restriction, one is without. The one without restriction is the one that will always be increasing. We think of it as an income type of account. It's going to be increasing in the credit direction. Therefore, we're going to be increasing or crediting the one without donor restrictions. The one with donor restriction then is going to be a debit account. It's going to have a debit balance. I would still think of it as basically an income type of account, which is going down. Therefore, we debit it to decrease it. So that's going to be the debit side. Recording this, though, you'll always see that the one without the restrictions will be having a credit balance. It will always go in the direction of a credit balance. The one with restrictions will always have a debit balance. You just want to, when you convert this over to thinking about it from the statement of activities section, you want to be thinking about the one without the restriction as going up, or removing the restriction, and the one with restriction going down. It also might help to think about that by saying, well, the one that's going up is increasing what would be kind of the net income down here, because this would be credits minus debits, revenue minus expenses. And the one that's going on the debit direction is kind of decreasing. So that might help you to remember as well. Next, we will record depreciation on equipment. This will be a fairly straightforward type of transaction, look much the same in a for-profit type of organization. You'll recall that the equipment up top is what we have purchased. That is going to be property, plant, and equipment we put on the books as an asset as opposed to an expense when we purchased it. And then we're going to allocate the cost in accordance with the matching or the expense recognition principle over the time period that we use the equipment. So the same transaction, we're going to debit the depreciation expense. We're going to credit, we're just going to call it this time allowance for depreciation instead of accumulated depreciation. Same idea, different name. So the idea then, or what will happen then, depreciation then increasing. So we've increased the depreciation. That's going to decrease net income or put us further into a loss in this case, given the dark blue accounts. And we have increased the contra asset account of the allowance for depreciation, similar to accumulated depreciation. It then going up, which would bring the book value down, which would be the cost minus the accumulated depreciation or allowance for depreciation.